Hello guys, so back with this, but like I said before, I'm not giving up. We must finish this today. We must do this. We must complete this. So just give me a moment. All right, so let's go on. We're back live. Hope I'm audible and everyone can hear me and see me. All right, so we're talking about market orders, limit orders, and stop loss orders. So this is where we're to begin before I went off again. All right, so let's go. All right, so what's market order? I'll start all over because I know I touched the market order and the limit order already. So what's market order? So like I said before, market order is when you enter a trade at the current market price. That's just the simplest way to put it. When you enter a trade at the current market price, all right. So this major purpose is speed and certainty of execution. That is major purpose, speed and certainty of execution. Its mechanism, as you can see, is written there boldly. All right, it executes immediately at best price available in the market. It is executes immediately at best price available in the market. Primary trade-off, you sacrifice price control for speed. That is what you sacrifice. Sacrifice price control for speed. That most people do market order because of speed. This is what this is what they feel. This is where they feel the market because at that moment you're not in control. You understand? You're not necessarily in control. All right. So with limit order, you're more in control of price at the moment. So what's the purpose of limit order? Limit order, like I said before. Okay, let me take it slowly. Maybe I'm talking too fast. All right. Limit order, like I said, basically is when you precise while entering the market, and you have better price control with limit orders. Market orders, you don't have price control. You understand? You have better price control. The mechanism is accused only at your at your specified price or better. So once you predict that okay, you predict that price you reach out to that the market will reach out to specific. All right, so once you predict and the market gets there, then it triggers your trade. That's basically it triggers your order. It opens the order. So you have an open order at that particular moment. All right, so that is what basically limit order is. Primary trader, your order is not guaranteed to be filled, and that's the fact. Your order is not guaranteed to be filled. That's a big fact. So that's the major trade-off for limit order. So it's not every time the price will reach that particular price, the market will reach that particular price list or price range that they predicted it to reach. You understand? So the order is not guaranteed to be filled. As for market order, the primary trade-off is you sacrifice price control For speed, you want speed, but you have less control of what happens of the price. All right. So stop loss order, trigger order. Okay. The next thing is stop loss order. All right. So what the purpose of stop loss order is automated risk management. Stop loss is very, very important. Very important. It's very, very important in trading, especially if you're trading futures. You need to take, you need to always put a stop, especially newbies. You need to always put your stop loss. Stop loss is very, very super important. All right. So mechanism, it becomes a market or limit order once a specific trigger price is reached. Understand? It becomes a market or limit order once a specific trigger price is reached. So for instance, let me just give you a layman's term. For instance, you predict that prices, maybe Bitcoin, because is our major thing. They predict that Bitcoin dollars $50,000 right now. Okay, so you predict that okay, once price reaches maybe $52,000, you go long. That once the price reaches 52,000, that's using a limit order. You go long and say once price reaches $52,000, market your order should be triggered. The order should be triggered so that it now rides the wave of maybe a trending and uptrend, a trending market. Like you understand? So since you put $52 as your limit order, you will now have to put a stop loss. A stop loss should be somewhere below that $50, so that if price goes against you and that $50,000, if price goes against you, maybe you put your limit order. Okay, I said the price was $50, $50,000. So even you put your stop loss order at $49,000. Understand? It should be higher than your liquidation price. It should not always be close. It should not be too close to your liquidation price. You understand? That's why you should put your stop loss order. So you now put it at $49,000. Say, okay, if price goes against me, or if market goes against me, and started going side and downwards, backwards instead of going upward. You understand? Started going downward. You understand? Please, once it reaches $49,000, if price reaches $49,000, should be triggered. That's what it is. So basically, you stop your loss. You understand? And most times, you understand? And most times, we we say we we say don't. Once we come to risk management, we talk about that. We say do not risk more than 5 to 10% of the portfolio. Most people say two to 3%, but some people do 5%, and so I have seen some people that do 10%. But as a beginner, do not risk more than 5% of your portfolio when you're doing a trade. Okay, not risk more than 5% of the portfolio. All right. So your stop loss is that price. Like you said, okay. Like I said, if price reaches $49,000, once it stops your loss, it will not reach your liquidation price. Understand? Understand? So your margin price, a little bit of the margin price will still be safe. Okay. Once this happens, whenever price triggers your stop loss, that is why stop loss is important. It prevents you from making or liquidating. All right. More explanation about this will come up later. So as we go along. So, but that's just a brief explanation of stop loss. In layman's, I'm just trying to break it down in the simplest way possible. All right, so limit order. Once a specific trigger price is reached, primary trader, it protects capital. You understand? It protects capital, but it can be triggered by short-term volatility, and